Hello, very good morning to all, and I hope that you all have a great weekend and a restful weekend. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Today will be Monday, the 27th of May, 2024, and a brand new week ahead. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right. Okay, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, cool. So before we jump straight into the short-term technical outlook of the broad-based cross-asset classes for today, let's have a recap of what has taken shape on last Friday over the weekend in terms of the cross-asset price performance and as well as the respective key economic data and events that drove the performance. So on last Friday, we do see a recovery in the major US stock indices. So on last Friday, what we could the performance on the 4 major US stock indices all ended in positive territory. The SPX is up 0.7%, the Nasdaq is up 1%, the Dow Jones almost unchanged, 0.01%, and the Russell 2000 also up 1%. So it's been a range of 0.7% to 1%. So what we could see over here is that, yes, despite that sell-off that occurred on last Thursday, we did highlight in our Friday Daily Dose of Market Insight is that the leading US stock indices, US stock indices, Nasdaq 100, is still holding firmly above the 20 and the 50-day moving average, indicating to us that the momentum is still bullish and the medium-term uptrend is still intact. And that's also why it drove the positive performance over on last Friday. So if you dissect the picture right now on what happened on the cross asset on last Friday, the market is still embracing this risk on behavior. Why? Because what we could see over here is that stock performance is up. If you look at the US stock indices that I just shared with you, the US dollar is still rather lethargic. I mean, there is still no clear dollar strength nor dollar weakness. How do I view that? By looking at the US dollar index. So the US dollar index, taking as a proxy of measurement of a broad-based US dollar strength or weakness, the US dollar index is down 0.29% on last Friday. And if you look at it from a technical perspective, it failed to actually break above a very clear key near-term resistance at 105.20, this red line here, as you can see on my screen. So what is this 105.20? Graphically, is the former minor swing low now turns into a pullback resistance of 9 of May, and as well as the downward sloping 20-day moving average that failed to gain any traction on the upside since the bearish break of it on the 2nd of May this year. You may see the start of this month. And what's interestingly, on the bottom is being well supported by the key 200-day moving average, confluencing with a key medium-term pivotal support at 104.20. So what we could see over here is the US dollar is being sandwiched by these two key levels, 104.20, 105.20. So indicating to us on the above, there is actually resistance preventing the dollar strength from pushing up higher, and at the bottom there's a key support supporting it, which is the 200-day moving average at 104.20. So what we could see over here is that the dollar is still being range bound between these two levels. That means what I could say that from a medium-term perspective, you look at the daily time frame, that means there is no clear dollar strength or dollar weakness at this juncture by looking at the dollar index as a proxy. So that's actually supporting this ongoing risk-on behavior that is still inherent in the US market, driven by positive momentum, driven by AI optimism. We got to respect that, even though some of us may say that the valuation is high, but the uptrend is still intact for Nvidia, which is very clearly the key driver that is supporting the ongoing bullishness in the Nasdaq 100, the S&P 500, and in some aspect, lesser aspect of the Dow Jones Industrial Average. Why? Because the Dow Jones Industrial Average has very low weightage in AI component stocks like Apple, okay, or Microsoft. It has a higher weightage on banks and some of one of the key healthcare stocks. Later I'll share with you the Dow Jones component. That's why you can see currently in the last 2 or 3 days, there's this slight underperformance of this Dow Jones Industrial Average over the Nasdaq 100. So now back to this situation over here. Then with that respect, dollar week, we do see a bit of gold recovery coming into the market on last Friday, still holding above their 20-day and 20-day moving average, bouncing off from it. It didn't break down, so a slight recovery on gold on Friday, and this WTI crude oil continued to remain weak, below that 78.40 level that has been taken out in the early part of last week. All right, so it's more of a momentum negative play factor that is actually taken on oil prices right now, despite the fact that there is still geopolitical risk premium that hasn't really resided in the Middle East region due to this ongoing Israel and Hamas conflict. So now back to the picture over here on the share view is on Friday, despite the fact that the dollar is not that strong, it's sideways. In fact, it came down on Friday. That led to a pickup in the US major stock indices. But however, what we could see over here is that the US government bonds, they are actually on the upside rather than the downside. So what I could see over here is that there's actually a desynchronization between what happened in the bond market right now in US, filtering up over to the US dollar index and as well as into the stock market. That means there is a breakdown between this fundamental link. All right. So what do I mean by that? Traditionally, the fundamental link is if you start to see bond prices yield, not prices, yield, bond price yield, US Treasury yield increase on the uptick, it could drive dollar strength, and potentially dollar strength come in, you see a risk off behavior. That is the fundamental linkage. But this fundamental linkage is not present in the market right now. All right. So what do I mean by that? If you look at the US 10-year Treasury yield, on Friday, it continued its positive performance on the 2-year Treasury yield, going to inch slightly higher after Wednesday and Thursday strong push up above the 20-day moving average. So if you look at the 2-year Treasury yield, is in fact now resuming its medium-term uptrend that is still in place since 15th of January this year within this ascending channel. And the longer term, the 10-year, not that strong as compared as to the 2-year, but it's still holding. It's still trying to break up above the 4.5% level on Friday. That means still below that 20-day moving average. So that 2-year Treasury yield, if you look at it over here, is a shorter term yield that is much more sensitive to monetary policy in US. So what it means that the 2-year Treasury yield inching up higher, it means there is a lower chance of the Fed to enact very aggressive interest rate cuts going forward. All right. So with the rise in the 2-year Treasury yield, that also explain why towards the end of last week, the US pricing, the interest rate price, the Fed funds futures interest pricing only now starts to price in one interest rate cut for 2024. Previously, at the start of last week, they start to put in 2, but right now it's only 1. And on last Friday, this remains status quo. So the Fed funds futures pricing is now indicating only 1 interest rate cut for 2024 at this moment in time. Why? Because of that faster rise in the US 2-year Treasury yield. Okay, so if you look at this over here, based on the CME Fed Watch tool, so those who have followed my daily dose of market insight, I've been flashing this for many times because this is the easiest way for us to get an indication what is the market pricing ahead of upcoming FOMC meetings in terms of the likelihood of either interest rate cut or interest rate hike based on the expectation as being expressed by the Fed funds futures market. So if you look at the cumulative probability, let me expand my screen, okay, to 200%. Okay, so that can be seen very clearly now. Okay, go to the bottom. This is where we have the aggregated meeting probability. At the row will be the Fed funds futures, Fed funds rate, not future, Fed funds rate. So currently the Fed funds rate is at 5.5% to 5.75%. If you shift to your left, it shows the reduction, okay, in the Fed funds rate by 25 basis point each. And the column shows you the various meeting date going forward in terms of month, day, year. That's American convention. Unfortunately, I can't change this date to UK convention where we start to show date first followed by month. All right, so we just got to stick with that. So based on the next upcoming meeting on 12th of June, market is expecting no what is it? One second. Yes, market. Okay, one second. Give me a minute. I think it's something wrong with this. Let me refresh it. Okay, so now the current rate, my apologies, is 5.25% to 5.5%. All right. So market for June, if I go back to the accumulated probability again. Okay, so this is the current rate. It's not this rate. Okay, my apologies, a slip of my tongue. So the current rate is 5.25% to 5.5%. So market is expecting no interest rate cut at the June in the June meeting because it's expecting 99% probability to remains the same. All right, a very slight chance of less than 1%, 0.9%. Market is expecting a hike to 5.5 slash 5.75. Okay, and if you go down the next line of meeting, very similar as well. Okay, it's only in even the September meeting over here, there is a slight chance of 45% or 46% increase to a potential 25 basis point hike to 5% to 5.25%. Okay, a jump from 10% that is expressed in the July meeting. Okay, so if you go down the calendar over here, November 46% as well at the 5% to 5.25%. But November meeting only pricing in only 15% chance of another 25 basis point hike to bring it down lower to 4.75%. That's very lower. That's not even 30%. And in the December meeting, there's a slight increase to 31%, but that's also quite low as well. All right. So previously, about a week ago, we do see that the December meeting has a chance of 50% chance of another interest rate cut. Okay, before 2024 ends. So at the point in time, at the start of last week, there was actually two interest rates being priced into the Fed Fund futures market. But right now, there's only one interest rate cut that is being priced in at this juncture. All right. So overall, right, because what's causing this lackluster pricing of interest rate hike in 2024 is due to that rising 2-year treasury yield. So that's the interlinkage, right? So fundamentally speaking, if we start to see a slowdown in interest rate cut expectation as expressed by the CME Fed Watch 2, fundamentally speaking, that could actually add downside pressure on the US stock indices. All right, but right now the US stock index is not showing that. Why? Because of positive momentum factor is having a bigger say over fundamental. Okay, and how do we know that? By looking at the ratio chart. The ratio chart where I could derive from the S&P, using the US market being that's the most liquid market, the S&P 500 momentum factor over the S&P 500 quality factor. So what do I mean by quality? Quality factor is where the ETF is being ranked by the component stocks that has higher quality will be ranked number one. So quality factor could be debt ratio, debt to equity ratio is one of them. Better profitability, net profit margin also could be one of them. There are various quality metrics, but unfortunately, the quality ETF is actually underperforming right now. And how do I do that? By expressing the ratio of the quality ETF against the normal S&P 500 ETF. So look at this chart over here. You can see what do I mean by this. So the top chart is the S&P 500. Very clearly, is clearly in a medium-term uptrend by trading above the 50-day moving average. All right. So bear in mind this trading view. If I could plot a 50-day moving average on a weekly chart as well. All right. And if you look at this green line here, it's actually the ratio of the S&P 500 momentum ETF divided by the S&P 500 ETF, the normal ETF. And you very clearly is shaping a series of higher high and higher low after that very clear major bullish breakup of a former minor swing high over here at this juncture. And it's been clearly turning upwards since late April this year. Okay, what we could see very clearly. So what it means that the momentum component, okay, the momentum stocks inside the S&P 500 is leading the fort. That means the AI play, the technology stocks. And how do I do that? By looking at this S&P 500 momentum ETF divided by the S&P 500. How do I get the S&P momentum ETF? You can Google and they will have a list of how do they compile this S&P 500 momentum ETF or index. So basically is that they rejuggled the component stocks inside the S&P 500, taking the momentum factor as a weightage instead of market cap, which is the S&P 500. All right. But however, if you look at the quality, that means the one that has better fundamental, the quality ETF, it's still hovering below a major resistance line by plotting the S&P quality factor ETF divided by the S&P 500. Okay, so this allows me to decipher that the current market movement on last Friday, why is it still so positive despite the fact that the fundamentals is not supporting it? That means the 10-year and the 2-year treasury US treasury yield is still being supported and still potentially has strength to tick upwards because the positive momentum factor is actually leading over the fundamentals right now. So we got to respect this ongoing positive momentum play that is inherent in the US stock market at this juncture. All right, so that is the current intermarket state of play that is going on in the cross asset classes at this juncture. And with that, now what are the key news that has taken shape on last over the weekend? Let me share with you all. There are a couple of news that over the weekend over here, but that's more of a longer term perspective. All right, so over here over at the weekend is we do have a G7 meeting that takes shape over the weekend among the global finance minister of the G7 nation. So they actually come up with a conclusion to actually slam China again regarding about their dumping of their EVs, electronic vehicle, cheap EV vehicles globally, and that could actually threaten trade escalation as well. So this will be a potential ongoing theme in also this upcoming US presidential election. So once it comes into the second half of this year and this particular global slamming towards China, that means i.e. blaming China for dumping cheap EV into the European markets and as well as the US market, and that could actually up the rhetoric of more potential trade tariffs that's being targeted on China in this upcoming US presidential election campaign. That could actually create a bit of short-term risk-off impact on the US stock market, but not for now. But that's when we come into the later part of this year in H2 once the US presidential election gain traction. All right, and also during the G7 meeting, President BOJ governor, which is Bank of Japan, big boss governor, Yuda did mention about that last week spike up in that JGB bond yield, which I highlighted to you all as well. So the BOJ achieved signal little sense of urgency after the steep rise in the JGB yield, especially the 10-year JGB yield breaching above their previous guided reference level of 1% briefly. Okay, very briefly, it hit about 1.01% on last Friday. So he did mention that on during the sideline of the G7 meeting, he did not signal any sense of urgency to actually be alert to this rapid rise last week on the JGB yield. That means indicating to us that he is no hurry to suppress the yield back to below 1%, the 10-year JGB yield. So what do I mean by this? A picture paints 1,000 words. So let's look at this. Okay, so do you realize that this was the rapid rise in the 10-year JGB yield? Okay, previously the 1% was used as a upper hard limit, but now it's even no longer a reference level. That means they removed the yield curve control on the top side for the 10-year JGB yield. So now it on last Friday it breached up the 1% mark. Okay, breached up 1% mark. And what we could see over here is that the 30-year also rose pretty rapidly as well. The longer 30-year, which is the Bank of Japan didn't actually buy the 30-year bonds. They target the 10-year to suppress the long end of the curve. Okay, so the 30-year actually went up steeply as well. So based on what BOJ Governor Yuda mentioned over the side of G7 meeting, he signaled little sense of urgency. That means, i.e., what it means over here is that it seems to us that the BOJ now is allowing more market forces to dictate the movement of the JGB market rather than the BOJ coming in every now and then to suppress the yield curve from ticking higher. And what does this imply from a longer term perspective? So from a longer term perspective over here, what it means that potentially the dollar yen could be facing potentially slower pace of appreciation going forward, given the fact that if the 10-year JGB and the 30-year JGB is being allowed by the market forces to detect its movement rather than BOJ keep on coming in every now and then to suppress their pace of potential increase. So that's more for a longer term perspective. Then for a longer term perspective, perhaps we may not see the dollar yen rising so much as we did since the start of this year in terms of the pace of appreciation. All right, so that will be the news. Okay, the news flow over here on last Friday, okay, on last Friday and last weekend. So now with that, let us now jump straight into the short-term technical outlook, starting with the major stock indices first over here. All right, so let us start with the major stock indices. Okay, where do we go? Okay, on the Hong Kong 33, the Hang Seng Index. All right. Okay, so with that, let me expand my screen. Okay, so on Hang Seng, if you recall, on last Friday or Thursday, the market price action came down, it pulled back. But since it's very close to the 20-day moving average, plus a bullish divergence that was cited on last Thursday, we maintain we actually have a bullish bias on last Friday because of this positive technical element, and indeed price action managed to survive at the 18,460 short-term pivotal supported on last Friday that we mentioned on last Friday, and today early Asia session it managed to shape a bullish hammer at the start of the first hour of the Hong Kong trading session for today. And what's interesting over here is that if we look at the current movement of the RSI, also getting very positive as well, as it's going to trace a series of higher low. So indicating to us there is some form of positive short-term positive momentum that is coming back into the market, and as well as the RSI breaking above this former minor parallel descending trendline resistance turns into a pullback support after shipping that higher low on the hourly RSI. So with this ongoing prevalent short-term positive technical element that is being fleshed out right now as we are speaking, we will still maintain that short-term bullish bias on the Hong Kong 33. For sure, 18460 will be the short-term pivotal support to maintain this positive momentum. First resistance to watch for today on the intraday basis will be at 18,870, this line here. Above it exposes 19,210. All right. However, an hourly close below 18,460 will invalidate today's bullish bias on the Hong Kong 33 to expose the next near-term support at 18,240. Below it sees 17,895, which is also the minor congestion area of 29th of April, and as well as the 50% Fibo retracement of the previous minor rally low of 19th of April to 17th of May, the 50% Fibo retracement. All right. That's for the Hong Kong 33, Nikkei 225. So the Nikkei 225, no change. Price action going to hold above last Friday short-term pivotal support level we highlighted. We saw the 20-day moving average as well at 38,460. So as long as 38,460 holds, we will still maintain the short-term bullish bias on the Japan 225. First resistance to watch 38,965. Above 38,965 potentially exposes 39,500 next. Only an hourly close below 38,460 will invalidate this short-term bullish bias to see the potential continuation of this corrective slide within a very complex sideways range configuration if price can't inch much higher and break below 38,460 to expose the next near-term support at 38,015, 37,750. Okay, that's for the Japan 225. Moving on, next will be the European stock indices. German 30 as a benchmark, which is the German DAX. So the German DAX going to inch much higher on last Friday after almost coming close to the 18,470 short-term pivotal support that we highlighted on last Friday as well, and also the 20-day moving average that's still being supporting it. All right, after last Thursday minor sell-off. So still no change, 18,460 short-term pivotal support level to maintain this short-term potential bullish bias. But price action got to break above 18,730. This something is like a potential upside trigger level to re-expose the current all-time high area at 18,920. Okay, so 18,720 was also the close to last Friday intraday high as well before it actually traded sideways. Only an hourly close below 18,470 for sure will invalidate this short-term bullish bias on the German 30 to see the continuation of this minor corrective decline that has taken shape on last Thursday to expose the next near-term support area at 18,320, which is the 50-day moving average, I think as a support level as well. Below it exposes 18,160 next. The Nasdaq 100. So Nasdaq 100, last Friday, we do have the 18,580 as a short-term pivotal support level, which is so the lower limit of this minor ascending channel support that I drew from 1st of May. Prices going to bounce up higher from here and cleared above the first resistance that we highlighted on Friday, which is at 18,740. So now this will become a pullback support for today, but I don't want to tie it so tight at 18,740 for my short-term pivotal support. So the short-term pivotal support still remains unchanged at 18,580. Why? Because it hasn't surpassed above the current all-time high at around the 18,990 level, which is the next resistance. So still no change, still maintain that short-term bullish bias on the Nasdaq 100, 18,580 short-term pivotal support level. First resistance to watch 18,990 slash 19,055. Above it exposes the next near-term resistance level at 19,160 slash 180, a cluster of Fibo extension level pointing to this level, 19,160, 180, and as well as the upper limit of this minor ascending channel that I highlighted in light green over here. Only an hourly close below 18,580 will invalidate the bullish bias on the Nasdaq 100 to see another minor corrective decline unfolding to kind of retest the 20-day moving average that's acting as a support at 18,230. Below it exposes the 50-day moving average that is acting as also as support at 18,100 next. Right, so these are the two resistance levels to watch if 18,580 is taken out on the downside. Now, the US Wall Street 30. So the US Wall Street 30, given the fact that it doesn't have much momentum stock as a we call it heavy weightage component. That means, i.e., there is no tech name that is actually in the top 5 component stocks of the Dow Jones Industrial Average that actually explain its lackluster movement on last Friday as well, still holding above the 50-day moving average, but can't surpass above the 20-day moving average. So still no change. We still have a neutrality bias for today on the US Wall Street 30 between 39,390 and 38,970. So to see the component stock of the various US stock indices, just go to something called slipchart.com. Okay, you're able to see it. It's slightly delayed, but I think 1 to 2 days. It's not live, but it's a good proxy. It's a good gauge to find out the component stocks of the various stock indices, especially during earnings announcement, because we're able to see which particular stocks that is driving the index. So you look at the Dow Jones Industrial Average, just click on company over here. Okay, because this is a free website, that's why you have lots of advertisement around. Okay, so what we could see over here, right? The top 2 weightage stock, right, is actually this United Healthcare. Okay, pardon me, there's lots of advertisement going on. Let me close this. How do I go back? Okay, sorry, my apologies, because this advertisement is a free website, so there's bound to have lots of advertisement. Okay, Dow Jones. Okay, so the top 2 is United Healthcare and Goldman Sachs in terms of their weightage at 8 and 7%. Microsoft, not that Microsoft, yes, 7%, but nonetheless, we do not have Nvidia, we do not have Amazon at the top 10. All right, and even Apple is number 14. All right, on the Dow Jones Industrial Average. So that should explain the lack of more high positive momentum tech component stock that has a higher weightage in the Nasdaq, and the S&P 500 is not being reflected in the Dow Jones Industrial Average. All right, so that actually explain the Dow Jones Industrial Average lackluster movement on last Friday as well. All right, okay, good. So now with that, let us move on to the short-term technical outlook on the major US dollar pair, starting from the European indices. So before I jump into the European indices, let's have a quick look at the 5-day rolling performance of the dollar against the major currency as of now we are speaking. So all of them, what you could see over here is more like a sideways movement. Okay, sideways movement since last Friday. Okay, at this juncture. Now with that, let us very quickly go to the euro dollar. So what you could see the euro dollar over here is that there's this push up on last Friday. This push up on last Friday, right above this 20-day moving average. All right, 20-day upward sloping 20-day moving average and the 200-day moving average, slightly above the 1.08 support level that we highlighted as well, the first support level that we highlighted on last Friday. And given this last Friday strong push up on the euro dollar, potentially, right, you could see a retest close to the range stop again at 1.09 level. All right, that means, i.e., we're talking about this level here. Okay, 1.0895, 1.090. Okay, which is also this area over here as well. Okay, so now with that right in mind, potentially it's more like a range bound play to push up to the top of the minor range resistance again, since it can't break below 1.090. Okay, previously minus swing high over here turns into a pullback support, and also the 20-day moving average that's acting as support as well. So with that right, I will be having a very minor short-term bullish bias on the euro dollar on a very short-term intraday basis, using for sure 1.08 as a short-term pivotal support for today. The potential pullback, because last Friday you see a steep move, right? So there could be a potential pullback coming in. Okay, at around this level here. Sorry, okay, yeah, this level 1.083. Okay, 1.083, which is also the 50% Fibo retracement of last Friday steep move. Expand it. Okay, 50%. Okay, sorry, 61.8%. okay, the golden ratio. So potentially it may do a bit of pullback. So as long as this pullback didn't surpass below 1.08 short-term pivotal support, potentially there could be another chance of the push up towards the upper limit of this minor range. I think as a resistance at 1.09. Okay, so for now, these are the key levels to watch for today. Short-term minor bullish bias within a range configuration. Key support level to hold in this minor bullish bias scenario in order to play out is at 1.08. First resistance 1.0860, close to last Friday minor swing high area, which is this very clearly this congestion area, this minor swing high that previously kickstart that sell off on last Thursday. All right, above it sees 1.09. Only an hourly close below 1.08 will invalidate this minor bullish bias on the euro dollar to see another round of extension of that corrective decline to expose the next near term support area at 1.077 followed by 1.0730. Okay, so that's for the euro dollar. Sterling dollar is one of the strongest due to the upcoming US general election. They're going to be caught on 4th of July. Very strong push up from the first support area that we highlighted last Friday at 1.270. So I'll be using 1.270 as my short-term pivotal support for today. Looking for a potential continuation of this minor uptrend phase that is still intact ever since it starts to hover within this minor ascending channel since the low of 22nd of April this year. So what we could see over here is that there could be a chance of a potential pullback given last Friday a steep movement up. So the pullback level to watch out for will be this area here, 1.2708 level. Okay, 1.2708 level, but as long as the pullback didn't surpass below 1.2670, because this will be a very clear key support level after that V-shaped bounce on last Friday, we will have that potential ongoing minor bullish bias that is still intact at price action continue to hover within this minor ascending channel of the sterling dollar. First resistance to watch for today will be at 1.2760. Above it exposes 1.28 figure level, which is also the 0.618 Fibo extension, and also the upper limit of this minor ascending channel as well. Only an hourly close below 1.2670 will invalidate today's minor bullish bias scenario on the sterling dollar to see a minor corrective decline scenario unfolding to expose the next support area at 1.2640/1.2610, which is also the 20-day moving average acting as support area as well. A break below it exposes 1.2565, which is close to the 50-day moving average and as well as close to the lower limit of the minor ascending channel that I drew from the low of 22nd of April. Okay, so all in all, it seems to us there is some form of minor bullish momentum that is creeping back in the European currency against the dollar. That means the euro and the sterling. Okay, as shown on the short-term technical element on the hourly chart that I share with you. Asia Pacific currency, let's start with the Aussie dollar. So the Aussie dollar also very similar as well. On Friday, it came down, kind of retested the 20-day moving average before trading back up higher. And while they test the moving average by shipping this lower low, all right, on the price action, but the hourly RSI starts to flash a higher low. Okay, so indicating to us some form of short-term positive momentum that is also creeping back into the Aussie dollar as well. So with that, right, I'll be using 0.6585 as my short-term pivotal support for today. To have that potential minor bullish bias scenario coming back into play for the Aussie dollar within its medium-term range configuration. Okay, why do I say it's a medium-term range configuration? Later I'll flash you on the daily chart. Okay, first support to watch for sure will be the 20-day moving average over here at 66.14 over here. So as long as that pullback didn't surpass 65.85, we'll still maintain that short-term bullish bias on the Aussie dollar. First resistance to watch for today will be at 66.50. Above it exposes 67.10 level. That means i.e. that it was last Monday's swing high. Only hourly close below 65.85 will invalidate this short-term bullish bias to see the continuation of this minor corrective decline to expose 65.50, which is the 50-day moving average. I think it's a support level. Below it, sees the keys, exposes the 200-day moving average at 65.20 level. Overall, it's still trading within a medium-term range configuration as expressed by the daily chart of the Aussie dollar, what we could see over here. Okay, the key medium-term resistance will be at the 67.30, 67.50, which is the upper limit of this symmetrical triangle range, which is this descending trend line over here that is in place since 3rd of February. So overall, it's being trapped by this descending trend line resistance and a ascending trend line resistance from the low of 13th of October. Okay, oscillating within this symmetrical triangle range configuration. So that's for the Aussie dollar. Then dollar yen. Okay, so dollar yen last Friday, we do have a slight bullish bias holding above that 20-day moving average at 155.90. So still no change as long as this 155.90 short-term pivotal support is not surpassed to the downside. Potentially, the dollar yen could still going to churn within this minor uptrend phase that is still intact, because price action going to trade higher high above the 20-day moving average, with the next resistance to watch out for will be at 158 figure level. So what's 158 figure level is in fact this area here, the minor swing high of 1st of May, and thereafter there was an alleged second BOJ intervention that takes shape under the instruction of the Ministry of Finance to sell dollar and buy it at this juncture here in early of May. Okay, so still no change, watching this 155.90 short-term pivotal support level to maintain that short-term bullish bias, with the first resistance to watch at 158. Only an hourly close below 155.90 will negate this bullish tone to expose the next near-term support area at 155.20, which is the minor ascending trend line that I drew from the low of 3rd of May. Below it exposes the next support level at support area at 154.10/153.70, be also confluence with the minor swing low of 16th of May and as well as the upward sloping 50-day moving average. So overall, what we could see over here is a bit of dollar weakness coming back into the picture on the European currency and as well as the Aussie dollar, but the dollar yen still remains supported by the 20-day moving average at 155.90. All right, so that's for the short-term technical outlook on the FX market. So very quickly on the gold, spot gold XAU/USD. So spot gold XUSD continues to trade higher above the 50-day moving average, where we use this as a short-term pivotal support level on last Friday at 2,307. Okay, because it's still pretty much key. This is the 20-day, 50-day moving average at their support, and so confluence with the previous minor congestion area over here of 8th of May to 10th of May. Okay, so what we could see over here is that momentum seems to be coming in as well, short-term momentum. Why? Because price action going to trace a series of higher high, all right, higher high and higher low over here, and it's now breaking above the 50 level mark as well. So still no change, still maintain that short-term bullish bias on spot gold XAU/USD. The first resistance to watch it got to surpass will be at 2,355 for sure over here. Above it exposes 2,407. Only an hourly close below 2,307 will jeopardize or invalidate this short-term bullish bias on spot gold XAU/USD to see a much more extension corrective decline to expose the next support area, which is the medium-term support area at 2,280/2,260 level. All right, that's for spot gold. WTI crude oil continued to remains lackluster. So if you look at the daily chart of West Texas crude oil, ever since the breakdown of the 78.40 level, okay, it break down this level, it can't surpass it last week, and right now during Asia session, it tried to retest this level again at 78.40. All right, 78.40. So if you look on last Friday, it came down on last Friday over here and hit our support at 77.20 before bouncing back up. All right, so no change, still using that 79.25, slightly above 78.40, which is also very clearly this level that induces the intraday sell-off twice on last Tuesday and last Thursday. So for sure, 79.25 will be indeed a key short-term pivotal resistance to maintain this ongoing bearish bias on short-term bearish bias on West Texas oil. So the first support level to watch for today will be last Friday swing low area at 76.70. Okay. close. Okay, maybe just put it over here. Okay, 76.70. Okay. Then thereafter, a break below 76.70 exposes the next support, short-term support at 75.50 next. Okay, this congestion area over here. So only hourly close above 79.25 will invalidate today's short-term bearish bias to see a much more bounce, a substantial correct bounce again towards a very, that means if this 79.25 breaks up, you will start to see a very messy sideways range configuration again. 79.25 break, the next near term resistance level to watch will be at for sure 80.50, which is the minor swing high of 20th of May, and as well as very closely the 200-day moving average also acting quite close to the 80.50 resistance level as well. Okay, so net still maintain that short-term bearish bias on West Texas oil as long as 79.25 short-term pivotal support is 79.25 short-term resistance is not surpassed to the upside. Okay, now with that, let us take a look at the calendar for today's key economic data. Okay, before we go, so today we do have European confidence data to watch out for, business confidence from Germany at 4 p.m. Singapore time. Okay, let me expand it. Okay, 4 p.m. Singapore time, and thereafter a pretty much quiet session. Why? Because the US stock market is closed for a public holiday for today. Okay, so with that, do have a great day ahead. This is Kelvin here signing off, and we shall speak again tomorrow. Thank you.